Global gold production appears to be approaching a structural inflection point that could fundamentally alter price behavior over the coming decade. After nearly 2 decades of steady output growth, the world's major gold mining operations are increasingly confronting the reality of aging reserves, declining ore grades, and diminishing exploration success rates. This convergence of supply-side pressures may be creating conditions for heightened price volatility and sustained upward pressure on gold valuations. Historical precedents suggest such transitions can reshape commodity markets for extended periods, with parallels observable in oil markets during the 1970s when conventional reserves began showing strain, leading to persistent price regime changes that lasted decades. The implications extend beyond simple supply-demand arithmetic. As mining companies exhaust their highest-grade, most accessible deposits, the industry faces a productivity paradox. Despite technological advances and operational improvements, the marginal cost of extracting each additional ounce continues to rise. Industry data indicates that average ore grades have declined approximately 30% over the past 2 decades across major gold-producing jurisdictions, while processing costs have increased substantially due to the need for more sophisticated extraction techniques. This dynamic suggests that gold's price floor may be shifting structurally higher, even as demand patterns evolve across different market segments. Mining executives increasingly acknowledge that projects requiring gold prices below $1,600 per ounce for economic viability may become increasingly scarce, fundamentally altering the industry's cost curve dynamics. Analysis of production data from the world's largest gold mining companies reveals a concerning pattern. Barrick Gold, the industry's second largest producer, has seen output decline from peak levels reached in the mid-2010s, with annual production falling from approximately 5.5 million ounces to under 4.5 million ounces in recent years. Similarly, Newmont Corporation's production has plateaued despite significant capital investments and operational optimizations, struggling to maintain output above 6 million ounces annually, even after major acquisitions. These trends reflect broader industry challenges that extend beyond individual company performance. Anglo American's decision to divest from South African gold operations and AngloGold Ashanti's strategic shift toward higher-grade, lower-cost jurisdictions illustrate the industry-wide recognition that traditional mining approaches may no longer be economically sustainable. The phenomenon becomes more pronounced when examining reserve life calculations across the industry. Many established mines are operating with reserve lives of less than 10 years at current production rates, forcing companies to pursue increasingly challenging extraction projects. The Witwatersrand Basin in South Africa, historically the world's largest gold-producing region, now requires mining at depths that would have been considered impossible decades ago. South African mines, once the backbone of global gold production, now operate at depths exceeding 3,000 meters, where temperatures can reach 60 degrees and extraction costs multiply exponentially. Ventilation, cooling, and safety systems alone can account for 40% of operational expenses at such depths. Similarly, Nevada's Carlin Trend, long considered the most productive gold mining district in the United States, faces declining productivity as surface and near-surface deposits become exhausted, requiring increasingly complex underground operations. Greenfield exploration success rates have declined markedly over the past decade. The World Gold Council reports that major new discoveries have become increasingly rare, with most recent finds located in politically unstable regions or requiring complex extraction technologies. This exploration deficit suggests that the pipeline of future production capacity may be insufficient to offset natural depletion rates. The mining industry faces compounding cost pressures that extend well beyond commodity price cycles. Energy costs, representing approximately 15-20% of total mining expenses, have experienced significant volatility linked to global energy market disruptions. Labor costs in key mining jurisdictions have risen substantially, particularly in regions like Australia and Canada, where skilled mining personnel command premium wages. Environmental compliance costs represent another escalating expense category. Stricter environmental regulations across major mining jurisdictions require substantial investments in water treatment, tailings management, and land rehabilitation. These regulatory requirements, while necessary for sustainable operations, add fixed costs that persist regardless of commodity price fluctuations. Capital equipment costs have also risen significantly, driven by specialized machinery requirements and supply chain constraints. The sophistication required for deep underground operations or complex ore processing facilities demands increasingly expensive technology, extending payback periods and raising the minimum viable project scale. The combination of production constraints and rising costs is fundamentally altering gold's supply elasticity. Historically, gold mining exhibited relatively responsive supply adjustment mechanisms, with marginal operations adjusting output based on price signals. This responsiveness provided a natural stabilizing force during periods of extreme price volatility, with high-cost mines typically shutting down during price declines and ramping up during rallies. The 2008 financial crisis exemplified this pattern, when numerous marginal operations suspended production as gold prices temporarily declined, only to resume operations as prices recovered and surged to new highs. Current market structure suggests this elasticity may be diminishing dramatically. High-cost operations can no longer easily ramp production during price rallies due to technical constraints and long lead times for operational expansion. Modern mining operations require 18-24 months minimum to restart suspended operations, compared to 6 to 12 months historically, due to increased regulatory requirements, workforce training needs, and equipment complexity. Conversely, the industry's high fixed cost structure means that production cuts during price declines may be more limited than in previous cycles. Debt service obligations, environmental remediation requirements, and community agreements create substantial ongoing costs, even when operations are suspended, making temporary shutdowns economically challenging. This reduced supply responsiveness could amplify price volatility in both directions, creating what economists term supply-demand disconnects that persist longer than traditional market models predict. Demand surges may encounter more inelastic supply responses, potentially driving prices higher than traditional models would predict. The 2020-2021 period demonstrated this dynamic when central bank gold purchases and retail investment demand surged, yet mining production remained essentially flat despite rising prices. Similarly, negative demand shocks might result in more pronounced price declines as supply adjustments lag market conditions. Mining companies' inability to quickly reduce output during demand contractions means inventory builds that can pressure prices more severely than in more responsive commodity markets. The evolving supply dynamics are coinciding with changes in gold's demand profile that could compound volatility effects. Central bank purchases have increased substantially, representing a more price inelastic demand component compared to traditional jewelry consumption or speculative investment flows. This institutional demand operates on different time horizons and price sensitivity parameters than retail or ETF-driven demand. The growing importance of ESG considerations in mining operations adds another layer of complexity. Companies face increasing pressure to demonstrate environmental and social responsibility, potentially limiting operational flexibility and adding compliance costs. While these requirements support long-term industry sustainability, they may constrain short-term supply responses to market signals. Technological disruption in mining operations could provide some offset to these constraints, but the timeline for meaningful impact remains uncertain. Automation, artificial intelligence, and remote operation technologies show promise for improving productivity and reducing costs, but implementation requires substantial capital investments and multi-year deployment periods. The geography of gold production continues to evolve, with increasing concentration in regions that may present different risk profiles for global supply security. Chinese production has grown substantially, but primarily serves domestic demand, limiting its impact on international markets. Russian production faces ongoing uncertainty due to geopolitical tensions and sanctions regimes. African production, particularly from Ghana and Mali, has expanded but often operates under challenging infrastructure and political conditions that can create supply disruptions. Australian production remains stable, but faces increasing cost pressures and environmental scrutiny that may limit future expansion potential. This geographic concentration and regional risk exposure could create new sources of supply volatility unrelated to traditional market fundamentals. Political instability, infrastructure limitations, or policy changes in key producing regions might generate supply shocks that amplify price movements beyond what demand factors alone would justify. The convergence of these supply-side factors suggests that gold markets may be entering a period of structurally different behavior patterns. If mining companies cannot efficiently expand production in response to price increases, traditional equilibrium mechanisms may operate less effectively, potentially leading to extended periods of elevated price volatility. The implications are particularly significant for algorithmic trading systems and quantitative models that rely on historical price-production correlations. Many institutional investment strategies may require fundamental recalibration, as the traditional inverse relationship between production costs and profitability becomes less predictable. Market participants may need to recalibrate their expectations around gold's price stability and supply responsiveness. Investment strategies that rely on mean reversion assumptions or predictable supply responses to price signals may require adjustment to account for the changing underlying market structure. Hedge funds specializing in commodities arbitrage, for instance, may find that traditional spread trading strategies between gold and other metals become less reliable as gold's supply characteristics diverge from more elastic commodity markets. The implications extend to monetary policy considerations as well. Central banks that rely on gold price stability as an inflation hedge or portfolio diversification tool may find that these functions operate differently under a more supply-constrained regime. Furthermore, the insurance and derivatives markets for gold may need to repricing risk premiums to account for the increased likelihood of supply disruptions and prolonged price volatility. Mining finance, traditionally structured around predictable production profiles and stable operating costs, may require new frameworks that account for the increasing uncertainty in output projections and cost escalation risks. These structural changes in gold supply dynamics represent one of the most significant shifts in precious metals markets since the abandonment of the gold standard. Understanding and adapting to these evolving conditions will be crucial for market participants across all segments of the gold economy, from individual investors to central bank reserve managers to multinational mining corporations.